Something strange is happening inside North America's auto industry, and almost nobody saw it coming. A move that was supposed to strengthen America's manufacturing comeback may end up revealing the country's biggest economic weakness. It began with a single announcement. Stellantis, the global automaker behind Jeep, Dodge, and Chrysler, said it was relocating production of the Jeep Compass from Beampton, Ontario to Belvidere, Illinois. At first glance, it sounded like a patriotic victory. Headlines framed it as American jobs returning home. Politicians called it proof that the tariffs were working, factories reopening, jobs coming back, and the flag flying proudly over another plant on U.S. soil. But beneath the surface, something didn't add up, because this wasn't a company expanding. It was a company retreating. Stellantis wasn't rushing to invest in America out of confidence. It was running from new 25% import tariffs that made it too expensive to keep production abroad. And in trying to avoid one economic trap, the company may have walked straight into another. When the Beampton plant shut down in 2023, 3,000 Canadian workers were left in limbo. Local leaders called it betrayal. But in Washington, the mood was triumphant. For a brief moment, it looked like a win. America first in action. Jobs crossing the border north to south. Yet within days, markets began to push back. Stellantis shares dropped sharply as analysts warned that what looked like a patriotic headline could become a financial disaster. U.S. labor costs were higher, energy prices were rising, and by American rules were tightening supply chains to the breaking point. What was supposed to be a victory for American industry was quietly turning into a burden on American business. And here's where the story takes an unexpected turn. Because Canada didn't fight back with anger, it responded with strategy. While Washington cheered its short-term win, Ottawa prepared its long game. But before we get to how Canada turned the tables, if you've been finding our analysis valuable, take a second to subscribe. We're aiming to reach our first 1,000 subscribers, and your support helps us keep producing deep, independent breakdowns like this one. Now, let's dig deeper into what really happened when Stellantis came home, and why this move might expose America's real economic trap. When Washington announced its new 25% import tariff on all vehicles and light trucks built outside the United States, the message was clear. America would reclaim its industrial strength by force. Factories would come home, jobs would return, and the era of dependency on global supply chains would finally end. For many, it felt like history repeating itself, the revival of the old protectionist dream. The White House framed it as a patriotic stand, the kind that echoes through campaign rallies and press conferences. Were bringing back American manufacturing, but the numbers told a quieter, more troubling story for Stellantis. Those tariffs didn't create opportunity, they created panic. The company had spent years optimizing its production lines across North America and Europe, engines assembled in Mexico, transmissions from Italy, components from Canada. Every part of its operation was designed for efficiency across borders, and overnight that efficiency became a liability. By April 2025, the tariff walls went up. Within weeks, Stellantis began bleeding money. European components were suddenly 25% more expensive. The cross-border flow of parts slowed under new paperwork delays and customs bottlenecks. The company reported roughly $300 million in additional costs by the end of the second quarter. Its first-half net loss reached nearly $2.7 billion, the worst in years. Still, the administration declared victory. The president called it proof that America is winning again, but investors weren't buying it. Analysts at Jefferies warned that if the policy continued, Stellantis could face up to $7 billion in annual EBIT losses. 2 Jeep models imported from Mexico were suspended altogether. Temporary shutdowns rippled through Michigan and Indiana, forcing 900 American workers into unpaid waiting periods. And that's the paradox. A policy meant to protect workers was now leaving them idle. Tariffs are supposed to punish foreign competitors, not domestic producers. But Stellantis had become both a company too global to be purely American and too American to escape global costs. What started as a symbol of strength began to look like a warning. Protectionism might be the new weakness. Yet, while Washington doubled down on slogans, something very different was happening across the border. Canada wasn't shouting, it was calculating. In Ottawa, there was no panic, no outrage, only precision. The Canadian government understood something Washington had overlooked. The real power in modern industry doesn't come from threats. It comes from contracts. When Stellantis announced its move to Illinois, Canadian leaders reminded the company that it had already made binding commitments. In 2022, Stellantis had accepted billions in federal and provincial support to build its EV infrastructure, money that came with strings attached. Foreign Minister Melanie Joly sent a direct letter to Stellantis executives reminding them of those obligations. Anything short of your Canadian commitments will be considered a default under our agreement. Ontario Premier Doug Ford echoed the message publicly. We're not just going to sit here and say that's okay, because it's not. Behind the scenes, Ottawa began invoking legal clauses that could make withdrawal more expensive than staying. These weren't empty threats. Under the terms of the 2022 EV investment package, Stellantis was required to maintain a full Canadian footprint. Violating that clause could trigger penalties, revoke subsidies, and allow the government to redirect future production work back to Brampton or Windsor. The strategy worked. Stellantis couldn't fully leave, even if it wanted to. The company was effectively locked into Canada's industrial ecosystem, not by politics, but by design. And while the U.S. was struggling to manage rising production costs, Canada quietly began securing its next move. Ottawa activated the safety valves in the EV agreement, forcing Stellantis to preserve its component manufacturing in the country. Ontario expanded retraining programs to help Brampton workers transition into the new Nexstar Energy battery plant, a $5 billion joint venture with LG Energy Solution that promised 2,500 new jobs. In less than 6 months, what looked like a national setback turned into a blueprint for recovery. That's Canada's. Quiet power, the ability to turn disruption into stability, to trade noise for leverage. While the U.S. tried to rebuild strength through confrontation, Canada rebuilt it through structure. But the contrast was only beginning to show, because when Stellantis returned home to Illinois, what awaited it wasn't prosperity, it was a bill. Next, we'll look at how America's so-called reshoring victory began collapsing under its own weight, revealing the true cost of chasing economic nationalism. When Stellantis reopened production in Belvidere, Illinois, the mood inside the plant was one of cautious optimism. Cameras flashed, officials smiled, and speeches filled the air with promises of a new beginning. Jobs are back, they said. America is winning again. But within weeks, the illusion began to crack. For Stellantis, the move that was supposed to save money quickly became one of the most expensive decisions in its history. Labor costs in Illinois were roughly 25 to 30% higher than what the company had been paying in Ontario. The rollback of federal fuel subsidies in 2025 pushed energy prices up nearly 40%. And the strict Buy American compliance rules forced Stellantis to rebuild its entire supply network using only domestic suppliers, a process that choked logistics, delayed parts, and sent production efficiency plunging. By late summer, U.S. factories were running at barely 52% capacity. Thousands of vehicles sat unfinished in holding lots, waiting for missing components. What Stellantis saved at the border by avoiding tariffs, it now paid back with interest inside the United States. The data was unforgiving. Between restructuring fees, retraining programs, and lost output, the company faced an additional $3.3 billion in costs. Investors didn't mince words. This is not reassuring, one analyst wrote. It's a reshuffling of losses, but beyond the spreadsheets was something deeper, something psychological. Washington's protectionist experiment was meant to symbolize control. The idea that America could bend global markets to its will. Instead, it exposed how vulnerable that system really is. When you try to force a globalized supply chain to behave like a national one, you don't strengthen it, you fracture it. Factories that once thrived on cross-border efficiency were now slowed by domestic bureaucracy. Consumers were paying more, workers were uncertain, and corporations were trapped between political loyalty and financial reality. The Made in America label was no longer a badge of pride. It had become a warning sign of rising costs and shrinking margins. And while the United States wrestled with the fallout, Canada was quietly proving that resilience doesn't require shouting. It requires design, patience, and policy discipline. Because north of the border, what began as a potential collapse was slowly turning into a model of reinvention. In Brampton, the assembly lines had gone silent, but in Windsor they were roaring back to life. While Washington fought to control headlines, Ottawa and Ontario focused on controlling outcomes. Their response wasn't dramatic, it was deliberate. Instead of chasing Stellantis with subsidies or rhetoric, Canada doubled down on its long-term industrial plan. The Next Star Energy Battery Project, a $5 billion partnership between Stellantis and LG Energy Solution, began full-scale hiring. Thousands of workers from BMPton were retrained and redeployed into new roles, ensuring that the disruption didn't become devastation. The Ontario government expanded worker transition programs, retooled vocational schools, and built partnerships with local colleges to create a new pipeline of EV technicians and engineers. By the end of 2025, over 2,000 former BMPton employees had been absorbed into Windsor's growing electric vehicle ecosystem. Meanwhile, Ottawa reinforced its safety nets. Unifor, Canada's largest private sector union, negotiated extended federal and provincial support for auto workers through 2027, guaranteeing income stability during the transition. The message was clear. Canada wasn't reacting to global shocks. It was preparing for them, and it paid off. Within 6 months, Ontario's unemployment rate held steady around 5.6%, remarkably stable given the scale of the Stellantis disruption. Auto parts exports to the European Union rose 18% in the third quarter of 2025. Over $1.22 billion in reinvestment began flowing into the Windsor-Essex region to support new suppliers and component makers. While the U.S. reshoring efforts strained under political and economic contradictions, Canada's approach was built on consistency. Ottawa treated industrial policy like infrastructure, not campaign fuel, predictable, rules-based, and insulated from short-term politics. That's why, in the eyes of global investors, Canada was emerging as a safe harbor in a turbulent North American market. Companies began viewing it not as an alternative to the U.S., but as a stabilizing partner, a place where contracts meant security and policy meant reliability. In a world of loud promises and fragile results, Canada's quiet, methodical response stood out. It didn't need slogans to prove resilience, it simply showed it. But this contrast reveals more than just two strategies. And in that difference lies the deeper lesson of the Stellantis saga, a lesson we'll explore next. As America's short-term politics collide with the long-term realities of a global economy that refuses to play by anyone's rules. Every few decades, America's leaders rediscover the same old tool: tariffs. They're easy to sell and even easier to misunderstand. On the surface, they sound strong. Punish the cheaters, bring jobs back, and restore industrial pride. But beneath that surface, the logic begins to crumble. Tariffs don't rebuild industries. They often reveal just how fragile they've become. Because when you raise barriers, you're not strengthening your domestic economy. You're just hiding its weaknesses behind a wall. The Stellantis move is a perfect example. The tariffs were supposed to force companies to bring jobs back. Instead, they forced Stellantis to make a desperate relocation to avoid penalties. Not to innovate, not to invest, but to survive. It's the kind of policy that looks powerful from a podium but feels chaotic on the factory floor. And here's the irony. Even as the U.S. tries to reassert dominance through tariffs, it's increasingly dependent on global partners for lithium, semiconductors, and battery technology, all critical for the future of electric vehicles. The illusion of control collapses the moment you realize that your domestic victory still relies on global supply chains that tariffs can't protect. Meanwhile, Canada, Europe, and even parts of Asia are moving quietly, offering stable, long-term deals for minerals, clean energy, and automation partnerships. While Washington plays defense, they're playing chess. This isn't just about aluminum, steel, or cars anymore. It's about who controls the future of industrial power itself. Which brings us to the most important layer of this story, the symbolic one. Every trade war has its scoreboard. Tariffs, deals, factory announcements, they all make headlines. But power isn't about who wins the headline. It's about who controls the rhythm beneath it. When Stellantis left Canada, it looked like a loss for Ottawa. But then within months, Canada doubled down on EV incentives, announced new partnerships with European suppliers, and secured mineral supply contracts that will feed the global battery market for the next decade. While the US usation paran markets about our US and Manation paran markets about our US and Manation pars about our US and Comation. Chem geminación, chem cheminación, chem cheminación, 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 chem cheminación, chem cheminación, cheminación, chem cheminación, cheminación, chem cheminación, chem cheminación, cheminación, chem cheminación, chem celebrated one factory coming home. Canada secured 5 strategic moves that will pay off for years. The symbolism is striking. One country is chasing optics, the other is building endurance. And as Professor Richard Wolff often reminds us, the true measure of economic strength isn't who shouts the loudest, but who adapts the smartest. Because power today isn't about controlling where factories stand. It's about controlling where value is created. And in that quiet race, the US may already be falling behind. Every economic system reaches a moment where the story no longer fits the reality. For America, that moment is now. The Stellantis shift, the tariffs, the nationalist language, they're all signals of a deeper struggle inside the world's largest economy. The US isn't facing a simple trade dispute. It's confronting the limits of its own model. A model built on the illusion that you can protect the past instead of investing in the future. Factories can move, tariffs can rise, and headlines can cheer. But you can't tariff your way to innovation. You can't wall off decline. Right now, 2 paths stand before America. Collapse, where protectionism and short-term fixes erode global trust. Investment and competitiveness or correction, where the country confronts its structural problems head-on, rebuilding its education system, investing in sustainable industries, and redefining what made in America means in a global age. It's not too late, but the window is narrowing. Every policy that's meant to win the war abroad is quietly weakening the foundation at home. And the truth, the one politicians avoid, is that the next American century will depend not on isolation, but on reinvention. Because the real victory won't come from beating Canada or China. It'll come from beating the cycle of denial that keeps America trapped between nostalgia and fear. As Professor Richard Wolff often says, when a system starts mistaking survival for success, that's when decline becomes destiny. This story isn't about Stellantis or tariffs alone. It's about how nations choose to face reality, whether they cling to symbols or confront substance. The illusion of strength has been America's favorite export, but it's also become its greatest weakness. If there's one lesson from this entire episode, it's this. Economic power doesn't come from shouting louder, it comes from building smarter. Canada's patience, Europe's planning, and Asia's pragmatism are all showing that quiet strategy can outlast loud policy. And as the cracks widen, we face a simple question. Will America double down on illusion or finally correct its course before it's too late? If you found this breakdown insightful, please take a second to subscribe. We're on the road to our first 1,000 subscribers, and every click helps us keep producing the kind of honest, independent economic analysis that cuts through the noise. Together, we can keep questioning the headlines and keep pushing for the deeper truths beneath them. Because as always, understanding is the first step to real